Good afternoon, everyone. This is Gonzalo Garcia from Agency One Insurance Marketing Group in Bethesda, Maryland. I'm privileged to welcome you all, as others I'm sure have, to the 2022 InsMark Symposium to talk about using Wealthy and Wise to enhance wealth transfer of qualified assets and annuities. This presentation is going to talk about a case that we worked on late last year. There were some real eye-openers in our planning, and I'm looking forward to sharing that with you today. Before we get started, I knew Bob Ritter back in the 90s. As many of you know, he passed away this year in July. He was truly a leader in our business and certainly a mentor to me and many others, and a good friend. So it's with heavy heart that we deliver this presentation. And Bob, in your memory, rest in peace. Thank you for everything you did. So $27 trillion problem. And I highlight this. This is based on research done by Statista of retirement assets in the United States from 95 to 2021. And you can see the growth here of all retirement assets as defined in the different boxes here. We're going to focus on IRAs, defined contribution plans, 401k plans, and annuities. And those are the blue box, the black box here, this gray box, and the purple box on top. And those represent the four asset classes that I want to talk about today. The rest of them are state and local defined benefit plans and private defined benefit plans and so on. So we're not going to talk about those today. Most of what we're talking about really are defined contribution or asset-based retirement planning tools, not income planning tools as our defined benefit plans. So why do I say we have a $27 trillion problem? Most of you know that retirement assets, while they will transfer directly to beneficiaries without going through probate, the downside is that those assets are often subject to federal and state income tax, as well as possible federal and state estate taxes. And while there's a lot of planning that we can do around that, and you're going to see some of the planning that you can do and how Wealthy and Wise will help you do that, it's important to understand R&D rules. It's important to understand the impact of income and estate taxes on these assets as they transfer to the next generation. And that's really what we're going to be highlighting here. So qualified plans subject to federal and state income tax. And what about annuities? So annuities, kind of similar issue in that really kind of two things. One is, if you have an annuity that is already started in the income, that has not started in the income phase, and is transferred in a lump sum, the beneficiary will have to include that lump sum in excess of the owner's investment in the contract or their basis, and will be includable in the beneficiary's gross income as income in respect of a decedent. That's under Section 691 of the Internal Revenue Code. If the death benefit is paid in the form of a series of periodic payments, then Section 72 is going to basically do the same thing in that it will be included as income over time, right? So as they receive income, they will have to recognize that as income in respect of a decedent. So the transfer of both of these assets at death caused some meaningful tax complexity to the recipients or the beneficiaries of those two assets. And again, assets, IRAs, 401k plans, defined contribution plans on the retirement side, and then annuities on the potentially on the non-qualified side. So let's talk about this case that we worked on last year. And this was a real life case. 75-year-old physician and his 73-year-old spouse. They both had 3 adult children, all married from the same marriage. These are 3 kids from their marriage. The client was a physician and still working at age 75, amazingly making a fair amount of income at about $600,000 after taxes. Their burn rate, what I call, their living, their lifestyle, was somewhere in the neighborhood of about $500,000 a year. Because they were both over age 70 and a half, and as many of you know, Secure Act extended that to 72, but they were already taking required minimum distributions from their IRAs. Total net worth was just north of $40 million. They had used $8 million of their lifetime exemption already. They had also about $10.4 million in non-qualified assets. So 60% of their net worth is where the problem comes in, and just actually north of 60% of their net worth. And they had $9 million in non-Roth IRAs, and they had $14.6 million in tax-deferred variable annuities. So those are the two assets that we're really focused on because they're creating a massive wealth transfer problem for this family. So let's kind of get into the numbers here. What Wealthy and Wise does, it allows us to set up the client's balance sheet and list asset by asset. For those of you that are familiar with Wealthy and Wise, you'll know what I'm talking about, but I'll give you a quick example here. So, you know, I'm now looking at the Wealthy and Wise software, and when it just needs to load up here for a second. So you're going to notice across the top of the page a bunch of asset classes, and here we go. So primary data, so we enter cash flow information, retirement plan assets, liquid assets, illiquid assets. You know, we get into some gifting and other assets and some illustration details and so on. So I just kind of want to give you a sense or a flavor of the massive amount of data that can be put into Wealthy and Wise as you're setting up a case. So I'm going to go back to this PowerPoint. So all of the information that we set up on the clients, and as you can see, I've broken it down here. So, you know, liquid assets, about $100,000 in, you know, cash on hand and liquid accounts at the bank. I mentioned $10.4 million in equity assets, which is really a managed portfolio that they have, non-qualified. Tax-deferred assets, there's your annuities, so $14.6 million in annuities. And then the doctor had $8.5 million in a regular IRA, and about $500,000 in a Roth IRA, and the spouse had $500,000 in a regular IRA and about $500,000 in a Roth IRA. So as you can see, their assets add up to their total retirement assets are about $10 million. So $35 million of liquidity. Not a bad problem, right? They're pretty much fully liquid. And then we look at the illiquid asset, they have a $5 million home. So there's the estate, right? So $40 million of estate. And we're going to really isolate and focus on the qualified plan assets and those tax-deferred annuities. So, and I'm going to show you why here in just a second. So there's the balance sheet, comes straight out of Wealthy and Wise. So when we did the summary analysis and we project this out to age 88, and remember, we're talking about income in, expenses out, growth of assets, inflation. So we're factoring all of those things into this planning. And at his age 88, her age 86, which is about their life expectancy, their estate, including all of their expenses that we factored in, will have grown to about $61 million. And that's this blue bar right here. So their total net worth is about $61 million. Their transfer taxes are $35.5 million. And therein lies part of the problem. So wealth to heirs is $39 million. Those two don't add up. You'll see why here in a minute. But you know, this is a meaningful problem. And this is not a problem that they thought they had. So they had really not done a whole lot of planning from an estate planning perspective. And this was the engagement that their advisor client was involved in, working with a financial planner. One of the things that we look at, and Wealthy and Wise does a great job at, is we always, and Bob Ritter used to say this all the time, clients are more afraid of running out of money than they are of any taxes that they will ever have to pay. So at the end of the day, all of the analysis that we do is we need to make sure, first and foremost, that all of their cash flow, their spendable cash flow needs are taken care of. And we do that. So that's the first thing we look at, and that's here in this box. So over their life expectancy, they will need about $8.5 million to live in the lifestyle in which they are accustomed to. And if we meet those cash flow needs, they still have a $35 million problem. Where does that problem come from? So obviously there's estate taxes on assets that they have, but the bulk of the problem, or a large portion of the problem, is in these qualified retirement plan assets and those annuities. So let's unpack that for a second. So $8.5 million in his account. You may recall back to this balance sheet, $8.5 million right here and $500,000 in her. So we're looking at only the IRA assets, not the Roth assets. So if you look at the retirement accounts that they have, and they're taking, remember, they're taking required minimum distributions out of this account. But the account is going to continue to grow. We're assuming a 6% return on these assets inside the plan. And we're assuming a 35% income tax rate at the heirs level. So at death, the heirs would have 35% income tax. So, you know, at age year 14, age 88, her age 86, his the combined plans will have grown to 9.3 million after all RMDs. The estate tax is $3.7 million. The income tax on the plan assets is 1.95 million for a total transfer tax of $5.67 million. That's a 61% confiscation of their assets. And this is a really important report because very, very few people really realize that upon death, IRA or any qualified plan assets will be confiscated at this level. So again, you've got an estate tax and an income tax on those assets and a confiscation rate of 61%. The annuities don't fare much better. The annuities are used as needed after their RMDs and after other things that you know, to meet their cash flow needs. But in effect, the tax-deferred annuities, excuse me, suffer a similar problem. So the estate tax on these assets is $13 million. The income tax is $6 million for a total of 19. So if you add up those numbers, you know, 5.6 and 19, that's about 25 or so, and that's $25 million out of the $35 million of transfer taxes that they're paying in their combined estate. So I get back to this number. So of the $35 million in transfer taxes, $25 million almost is coming from those two assets. That's a big problem. And what I want to talk about kind of for the rest of this presentation is really, you know, what did we do in terms of their planning? Let's do a quick recap. 75 and 73, 3 adult children, all married, still making $600,000 a year, and he plans on working for about another 5 years. So that's what we factored in here. Burn rate, expense rate of $500,000 a year after taxes. They're both taking RMDs. Total net worth of 40 million. Have already used $8 million of their lifetime estate exemption and their gift exemption. $10.4 million in non-qualified investable assets. $9 million in non-Roth IRAs and 14.6 in tax-deferred variable annuities. So, you know, just kind of laying that out again for you. So here's some of the things that we recommended. And I will say to you that this case went through a variety of iterations. As most people are, they are afraid to make irrevocable gifts. They're always afraid they're going to run out of money. It doesn't matter if you tell them they won't. So while we were making some recommendations of some pretty massive transfers and showing them that they could meet that $8.5 million burn rate for the rest of their lives, they were hesitant on taking on the full scope of the recommendations. So this is kind of where we ended up. They did create an irrevocable trust. And as part of the recommendation, they will be transferring, or no, they transferred, I'm sorry, $10 million of the non-qualified assets to this trust, leaving about 400 grand in the taxable estate. So as many of you know, the current exemptions for married couples is $24 million in 2022. That number has traditionally been indexed 2 to 3% over the last several years. Probably with some of the inflation we're seeing today, it might be a little higher next year in 2023, but that number continues to grow. They had already used 8 million, as I said before. So out of the 24 million, they had 16 left. We were going to use 10 million of that to transfer to a trust right now. The other recommendation that we made was to purchase $10 million of second to die life insurance in the trust and accelerate the payments over 5 years. You're going to see why we did that here in just a minute. But in effect, we are going to move $10 million of assets immediately. We're going to start accelerating IRA distributions and pay the taxes now to avoid that massive confiscation later. And we're going to fund the insurance over a 5-year period because those annual gifts to the IRA will further reduce their lifetime exemption, but they do have a pretty large amount of annual exclusions because of the 6 beneficiaries that they have. We did not, and I'll also make another note, we did not include grandchildren. No particular reason other than they did not want to do a multi-generational trust. There's a lot of things I can tell you about this case, but we'll just leave it at the simple planning because what we're trying to show is the value that Wealthy and Wise created in this planning. So 6 income beneficiaries, annual exclusions, and then the use of additional lifetime exemption. We still had, out of the 24, we used 8. We now use 10 more. They still had about 4 left. So they were able to continue to make gifts to the trust and meet all of this planning without any gift taxes whatsoever. So we're going to walk through what that looks like. Here's what the new balance sheet looks like. So I walked you through earlier what it looked like before. So no major real changes except right here, bear with me, right here, you'll notice that now the non-qualified assets are only $400,000. So I told you they had $10.4 million. We're going to take 10 million of that and move it down here into an investment trust. And we got that just literally with the stroke of a pen and a retitling of assets. We were able to take $10 million out of their taxable estate. Everything else pretty much remained the same. So that's the major difference here. Now, what we added as well is proposed survivor life insurance here. So we took and created $20 million of non-taxable, estate taxable assets and got it out of their estate immediately. Now, this has to be paid for, of course. And we're going to show you how we did that here in just a minute as well. So quick review of the balance sheet again. They had $100,000 of available cash in the bank. We took $10 million out of equity assets and left $400,000 in the estate. They still have the annuities. They still have those IRAs, both Roth and non-Roth, and they still have their home. So their estate went from $40 million to $30 million. I'm sorry, because we took that $10 million out, moved it outside of the estate, and then we added another $10 million for estate tax planning purposes. So that's kind of what the recommendations look like as an immediate process. Now, I mentioned that the first thing we do is we look at spendable cash flow. You'll notice that the cumulative cash flow provided is $12.9 million. That was the distributions from his IRA to fund the second to die insurance over that 5-year period. You're going to see how we did that here in just a minute. But we went from $35 million of taxes, if you will recall, now to $21.5 million of transfer taxes. We substantially reduced the estate to $30 million from, I believe it was $61 million before. And the wealth transfer to heirs is now $51 million. You'll recall that it was about $39 million, $38, $39 million in the previous scenario. We're going to show some comparisons here in just a minute. So that was the planning. Now, what does that look like on a comparative result? And so here kind of, both scenarios side by side. And again, Wealthy and Wise does some amazing reports and comparative planning, and you're going to see some of that here in just a minute. But the most important thing to show them was that during their lifetime, their spendable cash flow was not going to change. So you'll notice that in scenario 1, which is kind of where they are today or where they were prior to planning, $8.5 million over their lifetime of spendable cash flow. With the planning that we implemented, $8.5 million of spendable cash flow. Now, Remember back here, this number was 12.9. There's some pretty massive taxes that are going to have to be paid over that time period, but you'll see how that works here in just a minute, but you have to do that now in order to get the result of the wealth transfer. These people did not need all the money that they had accumulated over their lifetime. Their investment advisors, their tax accountants, I mean, everybody had done an amazing job at helping them at age 75 have a $40 million net worth. They've done all the right things. They had not yet done all the right things in terms of how to transfer that massive amount of wealth to their children and hopefully eventually their grandchildren, because the IRS was getting quite a big percentage of that estate. They weren't too happy about that. So, back to this comparative result, we went from the current scenario of $61 million with a $35 million tax and then just shy of a $40 million wealth transfer to a $30 million net worth. Irrelevant, because we are meeting their cash flow needs. We lowered their taxes by $14 million and increased the wealth transfer by about $11.5 million. And that is a meaningful result. And I can guarantee you that this scenario, this case could be tweaked further. But this is kind of where we landed. What does that look like here? In just a quick bar chart, you'll look at strategy 1, which is kind of where they are today. $39 million of transfer, as I said. Strategy 2, 51, that's almost $11.5 million more. And again, spendable cash flow the same. These are all reports that come out of Wealthy and Wise, so you're kind of seeing the value and the power of some of the analytics and some of the comparisons that we're able to show customers when you're working with them. And then, let's kind of get into the why. So I always look at this as part of this analysis because I think kind of this is where the rubber hits the road. I told you that we met all our spendable cash flow needs. I also told you that we took some pretty massive distributions, and we're going to get into how the software works, and you're going to see how that works here in just a minute. But you'll notice right here that there are some pretty massive taxes paid for those first 5 years. That's because we're taking big IRA distributions out of his IRA in order to make those gifts to a trust to fund that $10 million of life insurance. Now, you'll also notice that after the 5 years, the taxes go down meaningfully. Now, they have to continue to take, this is their RMDs. So assuming they did nothing, this is their RMDs as they're taking them currently. And if they did nothing more over their lifetime, they would pay $2.5 million of income taxes just on the RMDs alone. What we are suggesting is accelerate some of these payments here. Over your lifetime, you'll pay about $580,000 more in taxes, but you will transfer $11.5 million more to your children. And that is really the value of what we did here. And again, just if I was to net this out and do nothing more, would your client be willing to accelerate some of the taxes that they pay on their IRA dollars today for 5 years over their lifetime of $580,000 more in taxes, in income taxes to themselves, and use that to generate $11.5 million more to their children and grandchildren? Over a 14-year period, I didn't calculate the internal rate of return, but I guarantee you that that is a massive number. So $580,000 investment to generate $11.5 million more. And what you're really doing is you're disowning the IRS and changing the value proposition for your children. And that's really kind of, the bottom line here. So all of these reports, again, are all available in Wealthy and Wise. We're going to get to the software so you guys can see kind of the power of this package. And let's just do that right now. So I mentioned, all of the data that is needed. And I, as I said before, I've been using the software since it was called InsGift, and I've probably been looking at it for the last 25, 30 years. So I run through it fairly quickly, but I want to just kind of show you the power of the software. And I'm doing this because, in honor of Bob used to run people through these scenarios and show you the power of the software and do quick previews and so on. But let's get into it. So I talked about living expenses, right? So basically what we're doing here is we're showing this couple that their current desired spendable cash flow after taxes was $500,000 today. Now we're adding a 3% inflation to that. And you can see here that, we add the inflation rate here. This thing goes up by 3% each year. So as they get older, they're making, what is the equivalent of $500,000 in today's dollar over time. So in the last year, 734 grand, you can see the impact of inflation over time. That's how we set up their cash flow. We can add all sorts of cash flows in here. Travel, gift taxes due, long-term care, premiums for long-term care. I mean, we can customize and create all sorts of cash flow needs that they would want to take a look at. By the way, this also integrates really well when you're working with a financial planner, if you're not one yourself, with the financial plans that come out of, the variety of financial planning software that are commonly used in the industry. So we're always very careful to make sure that when we're doing these analysis, they jive fundamentally with a financial plan that may have already been done. So we're constantly checking with the financial planner to make sure that we're not kind of stepping on toes here. And I think that's really important when you're working collaboratively with a financial planning team or an advisor, an attorney, an accountant with a client, to make sure that kind of all those things come together. Otherwise, you're just creating confusion. So that's their burn rate, as I call it. When you get into expected cash flow. So what did we have here? What we had here was, Social Security. The software has a Social Security calculator, and you can go in here and put in their dates of birth and put in, whether they made over the Social Security wage base or not, and so on and so forth. And this has its own Social Security calculator and brings back the numbers here, right? We put in a 2% inflation on Social Security. As many of you know, 2023 and 2022 are probably got a much bigger number than 2%. But you can make this number anything you want. It changes the calculations immediately. And then this gentleman, as I mentioned before, was going to continue to work for 5 more years. So we included the after-tax cash flow from the medical practice for the next 5 years, and that's right here. Okay, no inflation. He's not going to give himself a raise or whatever. He's probably going to maybe even wind that down over time. But those were the numbers that were included in the calculations. Then we got to the retirement assets. And again, I'm going to go through this quickly, not to bore everybody. So defined contribution plans, these are the IRAs, $8.5 million for him, $500,000 for her. We're using a 6% growth rate. We're not scheduling any additional contributions. And here's the important thing. We're withdrawing funds only as required by law, right? So required minimum distributions. We're never going to take a penny more out because they didn't need it. They had so many other assets that they only needed the RMDs to meet their needs. This includes the most recent Secure Act changes for age 72 for RMDs. But since they were already 72, they were taking RMDs already, okay? We also had the Roths, and we just include the Roths in here. I'm just going to go through this very quickly. Liquid assets, they had $100,000 cash on hand. They had $10.4 million, as I said earlier. You can do basis calculations. We had about half of it. They had over time doubled the account over quite a number of years. And then we included the tax deferred annuities here. So they both had variable annuity contracts with Fidelity. This was their estimated values. This was the actual basis of the original contributions made into these plans. Again, we're showing 6% growth, obviously tax deferred growth, and we're going to use the income as needed. And then, withdrawals of tax deferred funds, you can make charitable bequests. I mean, there's all sorts of things that you guys can do to include in this software as part of the calculations. And again, her account was kind of the same, 5.2 million for her, $1 million of basis. Illiquid assets, here's the home. And then, I mentioned 3 kids and 3 spouses. So they have 6 annual exclusions each. We index those at 2% as well. And I told you they had made $8 million already of gifts to the children, and it used up part of their lifetime exemption. There's some other details here that we don't need to get into, but and then finally, any excess cash flow, and this is important, any excess cash flow that they have that was not needed, gets invested 100% into their non-qualified investment account. State and gift taxes, basically, for those of you that are familiar with this, the Tax Cut and Jobs Act of 2017, otherwise known as the Trump Tax Cut Acts, sunsets in 2026. So January 2026 is when that doubling of the lifetime exemption, if you will, and the gift tax exemption goes back to half. So that's what we include here. So it allows us to show the new rules, which are not so new anymore, but then reverting back to the 2017 rules. And then we can also put in some additional assumptions if needed. But that's kind of our default for most of this. They had no charitable bequest. We can certainly make charitable bequest here. And it allows us to do all sorts of planning and charity. But just kind of want to give you a sense of what this software allows. The reports, there's more reports and graphs and charts in here that you can shake a stick at, and I won't bore you with those details right now. So, you know, when you do this, do a quick preview here, and the beauty of the software is the speed that it has. So, you know, here's that balance sheet you saw earlier, right? So, you know, as I flip through these reports, and we print a nice printed binder report, or obviously create it in a PDF if needed. But, you know, I'm not going to walk you through all the reports. Trust me that all of the data that you saw in the PowerPoint presentation is just basically cut and pasting out of these reports. But you can see cash flow needs, need $500,000, index at 3%. We're providing that right here. And where's it coming from? Well, for the first 5 years, he's still working. He's making a fair amount of money. So we have all of this excess reinvested cash flow. These are the RMDs. They're required to take them. They're taking them now. You know, once his work ends, so you can see here, his income dropped from 667, which was Social Security and his work, to Social Security only. Here's the RMDs. He needs to take some money out of the equity assets to meet the cash flow needs that they have, and that's what we do here. So again, always doing that check of where is the money coming from? What bucket is that money coming from? It allows us to do an awful lot of tax planning, especially on the estate planning side. So I'm going to stop that right there, but that gives you kind of a sense of what the value of this software is. So that's how I set the case up for starters. And I'm just going to be done with that. And then here's how we do the planning. So this is, you know, gift of non-qualified assets in 2021, plus the purchase of insurance. This is just my way of naming, you know, storage names so I can find them later. But if I go in here to edit, I'm gonna walk you through some of the changes that we made. So you kind of see again the power of this software and how quickly it does some of these changes. I absolutely love using this. Okay, so real quick, this did not change, right? Spendable cash flow is the same. Expected cash flow is pretty much the same. Retirement assets, nothing really changed. I'm gonna come back to that in a minute. Liquid assets, cash on hand didn't change. You'll notice here, this is the first change. So instead of 10.4 million, remember I told you we took $10 million and just wiped it off their taxable balance sheet, or estate taxable balance sheet, literally at the stroke of a pen. Retitling of assets, set up a trust, took $10 million, made a gift in the current year 2021. This was at the end of last year, and reduced that estate tax liability, got it out of their estate. No gift tax because they still had this massive annual exclusion. So that's the first change. Didn't really do anything with the annuities, right? So those are both the same. Now, here's where the changes come in. You're going to notice here, I scheduled distributions. And I scheduled distributions because I needed $872,000 for 5 years to make annual gifts to a trust to fund a $10 million second to die policy. Why 5 years? Because we wanted to try to reduce the value of those IRAs as fast as possible. And 5 years created a guaranteed $10 million second to die death benefit, suited their needs. It suited his timeline relative to his work. So there were a lot of things about kind of getting this done and getting closure on their estate planning during the remaining 5 years of his working life. So we started with $8.5 million. As you recall, that was his own IRA. He's got to take an RMD, right? It's going to be $371,000, but we actually take more than that. So we meet the RMD requirements. There's some growth in there. And basically that's where we end up, kind of going forward. Okay. So that was the first change. Now, the second change was here in other assets. Remember I talked about an investment trust where we put that $10 million. Basically what we did here is I set up this asset, $10 million in the investment trust, growing in 6%. And you can see the value of that. This is kind of where the power of this planning came in, because we created two things. One was a $10 million trust, which was going to grow. And, by their age, 88 and 86, which we determined as kind of life expectancy, this was now had grown to $22 million. Remember that as a grant, and most people set up grantor trust, but these are grantor trusts, he pays the he and her in their joint income tax return pay the taxes on the trust's earnings. So how do you best invest inside of a grantor trust? You probably want to try to minimize dividends and minimize reinvested capital gains, but certainly you prefer capital gains to dividends, and try to get as much capital appreciation as you can so that you minimize those taxes. But we're factoring in here a 6% growth into this trust. So that's the first asset. And then the other thing that we did was we set up the insurance, that's in gifting right here. So in gift scheduling, remember I told you we're going to take IRA distributions of net after tax of $872 because that was our life insurance premium. So basically what we're doing here is we set up a policy for $10 million owned outside of the estate in the trust. And basically this is the way this looks, right? So I've got $872,000 of gifts to the trust. It tracks how much exemption I still have. So you can see that we were using both annual exclusion gifts and part of the remaining gift exemption. And that gift exemption continues to grow because there's an inflation factor on it. So in effect, we're always tracking to make sure that we've got enough lifetime exemption or gift exemption to make sure that they're not paying gift taxes during their lifetime. So we were able to make these $872,000 gifts to this trust without paying any gift tax and secure this $10 million second to die insurance policy on a guaranteed basis. So that's kind of how the software handles that. Again, a bazillion reports. I'm going to walk you through some of this stuff here in just a minute, but again, very quickly, I'm going to show you the reports that came out of this. And I'm going to walk you especially through some of the reports that deal with cash flow. You're going to see, again, the balance sheet. We saw this earlier. Equity assets went down to $400,000. We created $10 million investment trust and a $10 million survivorship trust. And then, here is the cash flow. So in order to make those $872,000, I needed over $1.3 million, which was combined 872 plus his plus the $500,000 that they needed. So 872 plus 500 is 1372. So there's kind of the number. We had 600 coming in. You guys saw that earlier. I took much larger distributions from the IRAs. You see that right here. And then we still have some excess cash flow to reinvest. This software kind of breaks things down for you item by item as you go through this. So again, $500,000 living expenses, 872.2 for insurance premiums, which basically is annual gifts. There's just more reports here than you'll ever really need in graphs and stuff, but this kind of gives you a sense of what this software is doing and how it's tracking everything. So that was the planning scenario. So again, I'm just kind of very quickly, cash flow needs were handled. We know what their expected cash flow was between Social Security and his income from his medical practice. We know what the IRAs were doing, both Roth and non-Roth. Liquid assets, we talked about the change that we made by funding that trust and taking this account from $10.4 million down to 400,000. We didn't make any other changes other than just basically set up the trust, $10 million trust. You'll recall this, growing outside of the estate because they made a gift of that $10 million under their lifetime exemption gifting ability. And we created a second to die life insurance trust and funded it over 5 years using IRA distributions and accelerating that. I'm going to take you back here to this page, and I'm going to begin to kind of wrap up here. Wealthy and Wise has tremendous amount of options. You have more reports than you need. It is not a complex package to use, but familiarity with it will be very helpful. In this case, I think the most important thing that we could have said to this client is, would you be willing to pay $580,000 more in taxes over your expected lifetime in exchange for $11.5 million more for your children and grandchildren outside of your estate? And that was the bottom line. Now, Wealthy and Wise gives you a tremendous ability to do a lot of this what if scenarios and cash flow planning. We could set up dozens of scenarios and do scenario after scenario, comparison after comparison. And, you know, I talked about these comparisons earlier in the software, but in effect, this allows us to do so much scenario planning to help clients and their advisors walk through these kinds of analysis. My time is wrapping up. I wanted to thank InsMark for the opportunity to work with you all and present this case. It was a wonderful case. It was a wonderful result for the insurance advisor, for the wealth management advisor, for the children, obviously, and for the clients. Agency One is here to help anybody who would like to know more about Wealthy and Wise and how to use it. We are very proud to have been a part of this in 2022 InsMark Symposium, and appreciate Don Pren and David Grant and the rest of the InsMark team for allowing us the opportunity to do this. So I believe now there's going to be a Q&A, and I will be live here taking questions from people in the audience, and I look forward to talking to you. Thank you.